Palo Alto stock is down around 8% over the last month, which could be a great opportunity to buy this growth stock company. As always, we'll look at the historical performance of Palo Alto. We'll look at their revenues over the last few years to see how well this company is growing year on year, top line as well as bottom line. We'll have a quick health check of the company, total cash versus total debt. We'll also see how well they're performing in their industry versus some of their competitors over the last few years. We'll also look to the institutions to see if they are buying more shares or selling on the more recent quarters. And we want to run through some of their financial metrics to see whether or not this is well positioned for the future as well as the performance over the last few years. We'll run through some insider selling that we have seen, notably a lot. We're talking over 40 million worth of shares and discussing whether or not this is a bearish signal. We're also going to look at Nancy Pelosi, who did purchase this and is remaining very bullish on this company, especially in the shorter term. And we're going to discuss why the company did fall on release of their earnings over the last few weeks. And don't forget what we always do, we run it through the valuation model, getting to our intrinsic value, getting to our acceptable buy price given our investor margin of safety, and also looking to see what Wall Street are expecting over the next 12 months. So let's start off with the historical performance. We can see they are down, in fact, on the day, market open 2.5%. Year to date as well, they are up, however, 5%. Over the last year, up 65%. And when we look at the last 5 years, a very strong performance of 271. Now, currently, they are trading in the midpoint of the 52-week range. Their forward P is 56.31, and their market cap does sit at around 100 billion. Now, top line growth, what we typically aim for here is around 3 to 7% for normal mature companies. Growth companies, though, due to the high P, we are expecting strong growth. 2.9 billion reported in July 2019. 6.9 billion in their latest annual report. So we can see some extreme growth year on year, very, very strong. We're talking a lot more than just that 3 to 7%. And in fact, over the last 5 years, they have more than doubled their top line. So looking very strong. We'll also look at the last 10 years percentage-wise as well. Bottom line, not what we like to see, a net loss in 2019. But on a more positive note, they have turned to a net profit in the more recent year, July 2023. And it's very nice to see that in the trading 12 months, they're expecting around 2.3 billion to that bottom line. So very positive. We do note, though, for the last 4 years, they were in a net loss situation. Very nice to note, July 23, a net profit. So lots to love. We will again break this down in our metric analysis. Quick health check then, total cash versus total debt. We see 2.8 billion of cash and short-term investments in 2019. In their latest quarterly report from last week, 3.4 billion. So they're holding more cash than they did just 5 years ago. When we're doing this health check, we also look numerically and directionally the movement of their total debt. And it has increased 1.4 billion to 2.2 billion. But as we mentioned, their cash is very large. And in fact, if they wanted to, they could pay off all of their debt net of cash on hand in less than 1 day. So again, we'll touch upon that, but the balance sheet looking very strong. Now, when we look at the information technology system software, we can see other competitors, CrowdStrike Holdings, Fortinet, ServiceNow, and a few others. Now, over the last year, in terms of the performance of PANW, they are up 62%, although we can see they're in the mid-performing of their competitors. We do see here, though, CrowdStrike Holdings up 160%. When we extend this to the last 5 years, we see that Palo Alto Networks up 270%. Very strong, you would consider, for a 5-year performance, but we can see the industry as a whole has performed very strongly. So again, whilst they have performed very well, in fact, we see their competitors performing much better. But even so, always bear in mind that past performance is not an indicator of future performance. Institutional ownership sits at 86%. Now we see 25 billion worth of sales by these institutions over the last 12 months. Interestingly, though, we see less buying by these same institutions over the same period. So they've sold more than they've bought. Although what we will point out is that in the latest quarter, Q4, there was more buying, 4.6 billion versus 1.8 billion sales. Again, do your own due diligence. This is one layer of our analysis and research, but do not copy them blindly as always. Now, in terms of buyers and sells, so we put it through the screener. We want to be transparent. We've looked over the last month as well. What we can see is a lot of selling by the insiders. We have the director, we have the vice president of the CTO, we also have the president himself, and we can see a lot of insider selling. In fact, just the more recent one last week of around $39 million. Now, a few things to note. Firstly, insider selling, it isn't a bearish signal. We don't know why they're selling. It could be personal or financial reasons. But also, since the more recent last 3 sales, the share price has gone up. So do take this with a pinch of salt. Do bear that in mind when you are using this in your own investment thesis. Now, before we do jump into the analysis, a few things to take note. We do see Nancy Pelosi is very bullish on this company, and with Nvidia that she did take some options into not too long ago that ran up very, very high. In fact, call options. She has done the same, as we can see from the filing for Palo Alto Networks. So again, it isn't something that you should base your essential analysis on. You shouldn't buy just because we see Nancy Pelosi, who did very well with Nvidia, bought, but it is something that we just wanted to bring to your attention. And that is why when we did look at that share price over the last month, whilst it did dip, we did see around a 7% increase to the share price on the back of that announcement. Now, very quickly looking at their performance, now we can see the main reason why their share price dipped in the first place was due to the fact that they did lower their full year guidance, although we do see that they did beat on the top and bottom lines. But again, what is important in these earnings is to look at their guidance, and they are anticipating slower year-over-year growth in both their billings and their revenue. So again, just something to consider. Remember, this is a lot of information, but do use it if you want within your own investment analysis. So before we jump into the analytics metrics, just to let you know, we have now released our latest free weekly newsletter article. If you want to grab access to this as well as others that we do have, all completely free, just sign up by clicking on the pinned comment below. Now, as always, free cash flow is what we draw your attention to. Earnings data can be susceptible to manipulation by management through accounting. So on the free cash flow, 23 cents in 2014, 8.68 in 2023, very strong rapid growth over the last 10 years. Granted, it may not be as consistent as you like, nonetheless over a longer time horizon looking very strong. 2024 expected to go higher as well at just under $9. Sales growth, this is what I quite like to see, double-digit growth year on year. Now, you could argue it is decreasing over the longer term, but if we look back from 2017, you could argue from 2017 to 2023, it has been fairly consistent around the mid-20s nearly every single year. So this is a growth company that is still increasing strong double digits year on year. And numerically speaking, it has gone from 600 million in 2014 to 6.9 billion in the more recent year. One thing that we don't like to see is those share issuances. We prefer share buybacks. So what we can see is they have diluted your position over the longer term. But what we would say is their share price has increased fairly strongly, and it isn't a lot of dilution anyway over the period. But always good to be aware and have this data available to use, especially when you want to consider it for your margin of safety. Now, return on invested capital, we can see that from 2014 to 2022, it was negative, it was loss-making. Nice to note in 2023, 9% looking very strong. And what I typically look for companies I want to invest in is around 10% as a minimum, just to give me faith that management are able to effectively allocate their capital. We can see they have improved their operational efficiency from 2014, where the margin was negative 12%. We are seeing positive on the 2023 number, as well as the trailing 12 months of 10%. And the free cash flow margin looking very, very strong. This is a very strong free cash flow machine. 43% in 2023. It is something I do quite like. Finally, the net debt to EBITDA, earnings before interest, tax, depreciation, amortization, gives me faith that the balance sheet does look to be very strong. As we can see here, this is 0. What this means is that in 2023 and expected 2024, it won't even take them 1 day to pay off all of their debt net of cash on hand. And that is pretty much what we concluded when analysing their balance sheet. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, getting into the valuation for this company, we have their free cash flow year on year. Now, average growth rate at around 87%. We've gone for around 15%, which is lower than what analysts are targeting and what management are expecting. We do want to be a bit more conservative. With the discount rate, we get the present value of future free cash flows and terminal value, which we add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding to get to our intrinsic value. Now, as I do mention and run through on these more growth stocks, this is a pretty subjective number and it does dictate the intrinsic value. So if you were someone who was like, this is a lot more conservative and you were a lot more bullish, you wanted to be higher than the growth rate that we have put in here, you expect it to still be lower than the average because you also want to be a little more conservative. At 25% for arguments, we would see a very high intrinsic value. You are someone who is like, you want to be a bit more conservative than the 15% that we put in. So at 10%, as you can see, the intrinsic value would be lower. So sticking with our 15% that we have gone for in today's episode, we get to the intrinsic value. Now, typically on the channel, it can be made up of different models. We only see it relevant, the DCF, for today's episode of Palo Alto Networks. So we get an intrinsic value of $382. Do bear in mind, though, that you can grab a copy of the valuation model to get to the intrinsic value, as well as the acceptable buy price of companies in your own portfolio, or those on your watch list, or even if you want to run through this company with your own estimates and judgments. So we use a margin of safety of 10%, and we use that if we believe it has three criteria: a wide moat, strong financial metrics, and good forward-looking data. We can keep going basically until we get towards the current trading price. So we see for today's episode, it has around a 20% margin of safety, which, depending on your investment thesis and your risk profile, you could deem this to be a fairly strong buy now. For those who are looking at a 25%, it would be around $287. So based on that, Wall Street are forecasting over the next 12 months a price target of $340. They do see upside of 12%, so they do see this as a fairly strong buy. As always, though, do let me know your thoughts in the comments below. Is Palo Alto Networks one you're adding to your portfolio? Maybe you added it on the dip when it did go to around that 250, 260 level, or maybe you are waiting for a better entry to go into. As always, I'm keen to hear your thoughts. If you enjoyed the episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you on the next one.